market's ripping higher, but nothing seems to make sense. Here's why that might be bullish. Lately, every headline screams recession risk. Rate cuts appear on hold. Geopolitical chaos as July 9th tariff pause remains. So if you're confused by this rally, you're not alone. A lot of us are. We're going to get into why it's actually broadening out and what actually might be happening under the hood. Today, we're going to break why some of these names are just defying gravity, especially technology. We're going to get into what smart money is doing and how you can stay ahead of it. We have a lot to go over. Let's get to it. Everybody, welcome back. Well, we have a lot to go over today. What I want to do is really focus on what's going on under the hood with institutions. I really want to focus on what they're doing, not only when they're doing it, but what they're doing. It's really important to get this concept. If anyone would look at this market and say, pauses are looming, meaning tariffs July 9th is coming around the corner. We're all seeing this over the weekend already, all the headline risk that's coming out on what they're talking about doing with tariffs and how they're talking about increasing tariffs with Europe. All of this is coming to a head, and we're going into some really weird economic data that just came out. We're going to break that down in some great detail and what the Fed probably is or is not going to do about it. But let's get to it. 27.5% of you do not subscribe to this channel. Please click subscribe and all notifications because these videos come out at different times. And it does help me with the algorithm, considering that I do not run ads. You'd be surprised how much that actually matters. And so what we're doing by combating that is just when you share this, it helps me greatly get the message out there. I think anybody that would look at this could not believe what's actually going on with the economy right now. Like they would just look at this and go, all right, well, we beat non-farm payrolls. We all saw the numbers. We all know we beat, and we're going to spend some time on that. We have to dive into it. But what's really going on under the hood here, because we're actually broadening out on the market. Take a look at this. When we dive into just the details, there's a green line right here. And, maybe we should change the color of that, make it red. Maybe that'd be easier to see. I don't think that is easier to see. I don't think the white, the white's going to be easier. Okay, we'll leave it white. And what I'm getting at here is just since July started, there are 40 sectors on this sheet. And look how many are below the zero line. So all you've been doing since July started is lifting. A matter of fact, if you just went day by day and said how many are now above the zero line just to start, it's a pretty good start with everything actually lifting more and more, not dropping off. Forget what's where, but just the fact that the majority are over the line. Take a look at this. In front of you is NDTH. Now what that is it is NASDAQ stocks above the 200-day moving average. So when we sold off, 18% was the level that we were at. Now, just to put that in perspective, when we've gone through major corrections in the past, down here, when we bottomed, 8% was where you were at. That means 92 names were actually below the 200 and 8 were above it, hence 100 names. If you take a look at it from that standpoint, you're at 18% to 75. And people are going to say, well, that's usually where it tops out. Not even close. When you go and take a look at this on a weekly, where this would top out, the data only goes back to 07. But if you go and take a look at the data, like where do you top out on this? You top out around 90, and you're nowhere near that. And by topping out, meaning that's the level where you may start to see, some rotation into some other names. So you're not anywhere near anything like that. You still have a long ways to go before you even got back to like the 23, 24 level. This takes a while to turn. It's not a quick turn. But what it's doing is it's actually continuing to push with the NASDAQ. So when you look at the NASDAQ, under the hood, it makes perfect sense because the breadth is there. Now, how about shorter time frames? Here's the NDFI. And anyone that has TradingView or any other platform can go and look these up. But this is the 50-day. And what are you seeing here? Well, you back down here when it happened, you were at a 5, meaning 5%, 95% below. Now you're up here and you're actually pushing and you're not even flipped over yet and you're heading higher, which means you still have a long ways to go here if this momentum is going to continue. Could you be derailed by some of the things we're about to go over today? Yeah, you could. But for now, you're not being derailed at all. Matter of fact, you're just being led. And before we go any further, here we are with the S&P 500. And what are we seeing here? Well, we have the 5-day that's back to the 80. We have the 20-day, remember 5, 20, 50, 200 that aren't familiar with this. And all of a sudden, we have the 20 back to the 80 level. We have the 50 back to the 78% level. And we talked about this when it flipped from 50. Now the 200-day moving average is at that 61%. All of these are aligned and all of them are pushing higher, which means that you're seeing massive rotation into different sectors. And what's happening is that rotation is happening daily. And what certain days you're seeing software go, and then you're seeing semis go, and then you're seeing other sectors come into play. I'll give you an example. See, we're climbing this wall of worry with the dollar, and everyone's looking at the dollar and go, well, the dollar's dropping. Nobody cares. Like, legitimately, no one cares. As a matter of fact, when you go and look at where the dollar is and everyone keeps waiting for this doom and gloom because the dollar's dropping, it's actually good for conglomerates because they make more money because people buy more goods. We just don't travel as much, we being in the US, which is where I'm at the time recording this. But okay, 89 seems to be a level that held in 18 in March, market ripped. 21, December 20, market ripped. You start looking at this and going, well, market ripped when the dollar went higher. So at this level, but where was it? Okay, well, you're not even back to levels that you were at previously. Now, if you go a little further back and you look at this on the weekly, what I tend to do is just go, well, where were we back in here? And what levels were like people really concerned about that you were just at this kind of trough level that didn't put you into a financial crisis? So can you get back to 80 and the market still go higher? Well, when you bounced off of 80 after you were done selling down and then you bounced off that level, you went on one of the greatest bull market rides in history. So is that what we're setting up for? Is the dollar going to be weak, come down to a number and bounce? I don't have a clue, and neither does anybody else. But what I do know is that people trying to all of a sudden put on the macroeconomic hat, and we're going to spend some time on this today. It's something I thought about a lot. All of a sudden, you have traders that are trying to be portfolio managers, determining that the dollar dropping is negative and not understanding that that's why industrials are going up. And it's really important to get this because it's going to explain why you're seeing the rotation, why industrials are actually hitting all-time highs, why people are looking at those names, why people are saying, well, do I start looking at Caterpillar or do I look at John Deere? Like, there's a reason why some of these names like IR are still down, why other ones in the cycle might do a little bit better. A lot of people like looking at Boeing as an example. I just always focus on this and always just feel like there's so much headline risk. And I just think that there's better situations like GE that make a little sense. And maybe the name industrial is kind of taking on a different face now with what we're dealing with on the AI side and data centers and building up there. But whatever you look at and wherever you're heading with this, you are seeing rotation. And that rotation that is also happening is not only going into tech, but it might be going into names like all of a sudden we're seeing a little bit on the basic material side. Well, why? How much does the dollar, if you're buying goods from domestically, go over there, and how does that affect us? And then also, you also have to realize when you look at the dollar, are you figuring out the correlation of the dollar in regards to the bond market? Do you even know how to do that? A lot of people don't. So they're just going, well, the dollar's dropping, therefore X, Y, and Z. And there's a lot of moving parts here, and you have to look at all those moving parts and all those variables. It's one of the things we actually were discussing in the community today on the day off. You have to look at all these different variables. It's so important, but take a look. This is a perfect example of what I'm getting at. If we take a look at the stocks, semiconductors, which lead, they're breaking out. You have a base here and you're breaking out above that base. If you take a look at the XLF right now, we're going to see that breaking out as well. And what are we seeing? We're seeing the XLF break out to all-time highs. I said this a week ago, and I'm just going to reiterate it. And no time in history ever has the market gone down and financials and semiconductors led. I said it again. And what you're seeing is you're seeing it broadening out, aren't you? Financials are going higher, even despite the fact that the data came out this week that we're about to get into is showing he's probably not raising or cutting rates rather anytime soon. And still, there were great trades to be had in these names. You know, we made 12, 13 points off of DPST. And it's just off the comments that came out. And so why is this happening and why are you seeing this rotation? Why are they buying these home builders? Why are they buying the home construction space right now? Like, it's all tied together. And once you walk through it and understand it, it really shows that you were probably a little more stable than we think we are. And a lot of it really has to do with headline and mean tweet risk. And we are going to address that as well. But let's get into it. I think we're at an important spot here. We have to look at what the Fed's doing and how important it is. So the Fed has that dual mandate, and we always hear the dual mandate. And I do think we should just go through this so that we're all on the same page about what that dual mandate is so that people get it. I'm pretty sure that everybody pretty much does, but I don't think it hurts to just refresh. You have to watch for inflation. If inflation's going higher, that's the Fed's fault. They have to lower inflation. If people start losing their jobs, that could be the Fed's fault, or the Fed could intervene. There's a whole litany of reasons why that could happen, so I really shouldn't say it's their fault. But inflation, most of the time, is their fault. If you take a look at the labor side of the market, if employment starts getting harder and people start losing their jobs and unemployment starts going up, the Fed is meant to intervene. So this is their dual mandate. If inflation's going up, intervene. If people are losing their jobs, intervene. Other than that, stay out of the way. It's what we refer to and what Jerome Powell refers to as their dual mandate. So now we know what their job is. And I think that this is where it gets pretty interesting because They have this dual mandate, and I'm going to go through non-farm payrolls and show you some of these numbers, but the chances of them easing next time are 4.7%. When you started a month ago, it was at 28.5%. This is off of fedwatch.com. Anybody can use this site. It's free, and it's a great site because it just tells you what's going on. But now you've gone from 28.5 to about a 4.7% chance, and this is for July. And so what we want to see here is we just want to pay attention to that. Now, if the Fed starts seeing different data that comes out, you still have December, October, September, all up in here, and you'll still have 3 more chances to cut rates. We keep hearing about these rate cuts. But right now, you're down to these 3 because there's no chance in July after what happened. It's very important not just to understand that we went, and actually even this week, we went from 18% all the way down to 4%, just based upon when we saw non-farm payrolls in the JOLTS data, despite that Powell saying that, hey, maybe it's not too early here to start doing what we're doing. So we have to dive into those 2 numbers, what's going on with the inflation side of the market and what's going inside with the labor side of the market. So I think the best place to start is just what happened on Friday. Well, actually, it was Thursday, wasn't it? So what happened on Thursday? Non-farm payrolls comes out, which usually is a Friday number. We came out at 147. Previous was 144. Consensus is right here, which is kind of crazy. And you just crushed. Now, this is where it gets really interesting because the data shows an unemployment rate of 4.1 versus the 4.3. We were supposed to uptick and we're down ticking. So when we go look at that one box on what the Fed's supposed to be doing, are people becoming employed? If you were to look at this at face value, you're going to say, yes, we're good. Then you start looking at some of the other data out there. And if you really dive into it, it's telling you a couple things. Yep, they're getting more employed, maybe, but the average hourly earnings are dropping. You were supposed to come in at 0.3, you came in at 0.2. On year over year, 3.7, you came in at 3.9. Okay, so maybe people are employed, but maybe they're making less money. We saw some of this in personal income and spending recently. We've seen a lot of variation in those numbers. But then you look at jobless claims, and we're staying in that range, which is fine. The participation rate is 0.1 here and there. It's not a big deal. Continuing claims are at 3-year highs, meaning if you lose a job, it's hard to find one. So that still falls into that box of what? The labor market that we have to watch. Because not only is this, but are these the jobs people want? And we're going to get there. Then we have this huge outlier right here. Out of non-farm payrolls, it's broken down into several different categories. But the 3 major ones are this. And then there's subsectors, which I'll show in a second. But you have private, manufacturing, and government. Let's start with the easy stuff. We'll just start with the fact that this is CPI, and this is 5 years, and this is all on Fred. So here's Fed, Anybody can go there and get this data. World Bank via Fred. And all I'm showing you is 5 years. This is where inflation was. This is where inflation is. Anybody with a brain is going to look at this and say inflation is what? Dropping, right? It's very simple. Now, does it uptick in the future? Tariffs, yada, yada, yada. Who knows? Right now, this is the hand that we're dealt. And that means that they are in check with what they're doing. We can talk about tariffs all we want, what they're going to do, but right now, this is the hand. So the Fed is doing their job right now. And let's start with the JOLTS number, because JOLTS is obviously really important. Now, a lot of people don't think about JOLTS this way, but JOLTS in and of itself is, here, let me just point it out for you, it's so simple. JOLTS opening labor turnover surveys. JOLTS, Job Openings, J-O, Labor Turnover Survey, and published by the BLS. This data is unique economic unmet demand for labor and labor shortages. So if this number is upticking, then you have an unmet demand for labor and labor shortages. Okay, which leads us here. We just look at that section very quickly. Tried to undercut there, tried to undercut here, and then you lifted. It actually ties in very easily with this level that we were at before. If we came to it and said, oh, this is where we really were pre-pandemic. Okay, so that kind of gets us back to that level. That's kind of interesting. You tried to break through, couldn't, tried again, couldn't, and now we're lifting. Is there more to this story about the jobs and the quality of jobs? Maybe there is, maybe there isn't. Now, if we go a step further into the non-farm payrolls and we just look at the numbers and say, all right, well, where are these jobs? Where are they being created right now? Because here's your total non-farms numbers up here. But where are the jobs actually coming from? If we start looking at those kinds of jobs from a total non-farm perspective, and you're just going to, I'll save everybody a bunch of time, accommodations, food, services right here. And we could see that huge jump. So from a year ago, you were right around the same number, and now you're having that huge jump. Leisure and hospitality, you can see that right here, and you can kind of go through it and also say, well, you saw a little bit of a jump here. Do we have any big declines? Trade, retail, retail trade's kind of fallen off a cliff. People are getting, kind of an issue there. It's not really what you're looking for. Okay. But in the food service spot, And the accommodation spot, yeah, they're looking. Another thing I thought was really interesting is when they broke it down by census. You can see that the West is losing and that the South is gaining. I thought that was pretty interesting as well. And if we dive into the number and start tearing them apart, you can do this yourself on any one of those subsectors. And I think it's worth just looking at and going, well, accommodations, food services, from a 5-year perspective, you're looking like you're getting ready to break out on job openings. And that's kind of interesting to me. Like, well, why is that happening in that space? Now, some people could say it could be because of the influx of immigration or the outflow of immigration. We're all just speculating on what it is. But the bottom line is this is what's happening. And that's where the job openings are. And then you want to look and see, is there anything really weird or out of place with hiring? And so you look at total non-farm hires, just the hires of non-farm. And you can break this down as you're going to see in a second. And the answer is no. There's nothing really weird here. You're in the same area that you've really been and have stayed since you cracked into it, which was right around that July area. You can actually just come straight across from here and see everything's been in the same essentially box for the past 2 years as far as hires on non-farm payroll. Or total non-farm rather hires. So what does this mean? It means tariff on, tariff off. Nothing's changed. We have one administration, we switch administrations. Nothing's changed. You're still in this range. Now we keep talking about these breakouts or breakdowns, but none of this is changing. And at the same time, what are we seeing? Well, we're seeing that inflation, which is the one mandate, and we're seeing that that's actually doing what it's supposed to be doing. And we know that with that mandate, if he cuts rates, we do know that inflation is going to go higher. So this does put you in a really difficult position, or a difficult position for him to cut rates. And just the other side of being hired is what? Quitting or fired. But what do you have right up here? Quits, total non-farm. What do you have? You have more people quitting. Well, why are they quitting? And I'm just going to throw the questions out here and be rhetorical about the questions. You can put in the comments what you think. But why are people quitting their jobs? Why is this happening? Why are we seeing quits go up right now? And I think it's worth bringing up, and then we're watching the unemployment drop as well. And let's tie this all together. So people are quitting their jobs, and obviously you can't fire or you can't file for initial claims if you quit your job. But here's the range that we've been in now. And again, I'm just showing you for 25 years up here. Anyone can go to this stuff. And what do you see here? Well, since 22, we've been in the same range. The high on this is roughly 258 or 259. So people are losing their jobs and they're not able to find another job, but people are quitting their job more now than they've been before. And now we have more job openings than before, but they might not be in this space that people want to have a job. Okay, so they might not want a job there, but there's jobs there. So it might not be their dream job, but there are jobs. And I think that that's kind of the crux here. The one thing that I really need to wrap my noodle around, and I think that really needs to be explained, and it has not been a good job so far, and maybe we'll get more data next week, so I will follow up on this. You have that 73,000 out there on governments, and it looks to me like the street's blowing that off as if it's a big fat zero. And I think the reason for that is they're like, okay, this is going to be an anomaly. There's no way that's going to continue. And therefore, that 147 number is going to be minus that. I'm interested in what you guys think. But when I take this data apart and you just look at it line by line by line, yeah, we could say governments this time or whatever it is. But if you look at this data, you have more job openings. People are not filing for initial claims at any significant level that you've seen for the past 5 years after where we've been. Obviously, this is just this huge anomaly up here that we're never probably going to see again, or hopefully never see again. So where does this really leave us? It leaves us with a Fed that is, for lack of a better purpose, staying the course, and things are going fairly well for them. And I don't see any data that's going to change that, nor does the street, because of the way they're betting. But we are seeing people start to buy what? Those interest-sensitive names, and we're going to get into that. Now, this is something that we looked at about 2 or 3 weeks ago, and the purpose of showing it then was we were talking about this 530 level. It was like 535, something right around there, but really it was like that 530 down here, that level. And if we come straight across with it, I'm just going to drop a line, and this is the last hour. And we'll get into exactly what the last hour is and what you're looking at here, because it's a cumulative AD line, and it's really important. But you can see that 530 was an area of interest, where before that 530 got us to that trough valuation. And then when you start coming out of that, you start getting these buys. And I think it's important to look at those levels and kind of figure it out. But what I really, really like about this more than anything is that you are setting up here for this to have that cumulative go higher. Before we go further and dive into this, let's just review very quickly what this chart is actually representing. The last hour is a cumulative AD line for the last hour of trading on the SPY ETF. If the last hour is trading up, you're going to add a value of 1. Seems simple enough. It's added to that because it's a cumulative count. So if you're at 530, you would add 1 to it. Now you're at 531, 532, 533 every time that it goes up. And then, of course, if the value is down, you're going to subtract it. So if the last hour is down on the S&P, then you're going to go from there. So if you want to do this yourself, you could just keep a running tally of 3 to 4 on the SPY ETF at the end of every day. Go up 1, okay, or down 1. I mean, some people actually even watch Wednesday, and if you don't get above Wednesday's high, they know that next week you'll probably be down, but we can do that in another video. Bottom line is what you want to do here is just the last hour. Just look at the last hour and go plus or minus, plus or minus. Real quick way to do that. You actually will get a sense of what you're going to be dealing with the next day, quite frankly. But this is a cumulative total, and they're not looking at that next day kind of move. What they're looking for is that building. They're looking for that cumulative move over and over again. And what they're trying to get you to do is a moving average strategy. I'm not really looking for that. What I'm looking for is these levels where cumulatively we start seeing buying come in the market. And why is that last hour so important? We know why, because it's institutions that buy there. That's why that last hour is so important. So if we sit here and take a look at that 5 hour or 5 year rather, what do we get? Well, we have this little area in here. As I stated, we came across, and I don't know why when you've gotten to this level that's where that trough valuation is. I'm not really sure why that is on the cumulative total. I'm not sure why when we're getting up to this 560 level, it seems on that level that's pretty much it. And then we could see how, well, it didn't really work here. Well, I mean, we didn't really need institutions to buy, did we? We had the Fed. They were buying $1.7 trillion of assets, which is why it's really hard to look at this period of time and utilize it, because it's just so false. I mean, you just see how straight it was. It was every day. The Fed was just out there buying assets and mortgages, and people can't figure out why they can't get a house. I mean, they were competing with the Fed. Anyway, if you take a look at where we're at and the breakout, we're going to dive into this a little deeper and watch this turn. Now, in front of us is the 3-year, and if we just mark off the breakout from here, you would say, well, why does the breakout matter? Because it's telling you that cumulatively, if you took from this spot on, you now cumulatively have more people buying now, institutions buying now at the last hour on a cumulative basis, the SPY ETF, than they were buying it here. That's pretty interesting. You wouldn't think that that would happen. A matter of fact, when you start hitting these highs, what you would note is that it does take time for that year end to start wearing off, right? For that, or last hour rather, to start wearing off. Look how you were dropping here before this even starts kicking in. And then when it finally dissipates, you're like, oh yeah, all that's left is retail. And that's usually when they sweep the leg and you get hit. It rebuilds and it takes time. That's why it's so important to understand for these pivots. It doesn't mean like, oh, I need to get in right now. It's just telling you like, hey, on the last hour, institutions are buying again. Institutions and pension funds are not buying to trade for next week. They're buying to put money to work for a period of time. That's why when you break over these levels, after you had them for so long, for example, even if you look at this one, it's significant. Those breaks are significant. And look at what's happened. You just kept pushing. Sure, you've had your little pullbacks over them, and nothing is perfect, but it does give you a clear indication that, yeah, it's on, and it's been on from them buying for the last hour since here. I mean, we're almost looking at June 1st, where it's just straight out every day, cumulative the last hour. Let's take a look here, just zooming in on the year. If we see the break from here over, okay, that's when the break starts to happen here. You really haven't seen the lift off of this yet. What you really are seeing is all this accumulation from this period of time that's leading to this, because institutions and retail at the last hour, that is being bought. It's very different than looking at smart money, dumb money, because you're actually seeing what they're doing. The smart money index does this too. It subtracts the beginning and adds at the end. And it's more of a timing than an order flow thing. And I just think it's a more interesting perspective, and it's a much different perspective. But you can see it takes time. So here you are in December and you're breaking down, and that breakdown doesn't happen until March, April, May. So what's the lead time? A couple months is usually what I tend to see with this. You usually have a couple month lead time when you come out of some kind of base, or you break some kind of support like here before you start seeing those effects. You can obviously see the break of that support right here. That puts you right mid-December when you start seeing that, like the real break of that support, the real break of that resistance. There's something to it, and I do think it's worth paying attention to. But the smart money index as well, subtracting or adding what retail's doing, and then looking at it from a perspective, I think Hayes created this in the 60s. Let's take a look at that real quick, because I also think that could give us some color here. Before we dive into the Smart Money Index, this one's a little more complex, but I do think it makes sense because there are some things here that it is identifying. And I think it's important because it's going to add another layer. We can look at smart money, dumb money for order flow, but it's not telling us what's happening at specific times in the market. And it's really not giving us a really great signal right now. But I think that this is kind of important because what it does is say, this is from a guy, Don Hayes, and what they're doing is saying that the emotional trading takes place at the beginning of the day. And we know that they tend to overreact one way or another. Retail tends to overreact, right? And then smart money, they don't overreact. Okay, but institutions. Due to that tendency, we want to bet against the opening action is what they're saying. And we want to bet with the closing action. So they want to bet against the opening and they want to bet with the closing. And what they do is they take the S&P cash for the first half hour of trading and they add that performance to the market. And they take that last hour and do the same thing. So the first half hour, if it's up, they actually make it a negative. So if it's down, then it's a positive. And then they do the final hour. If it's up, then they add it normally. So in other words, what you would see here is that if you lost 5, right, or gained 5 in the morning, they would actually take that 5 off. And conversely, if you're up 8, they would, if you were up 8 at the end, they would take it off. So it's whatever retail does in the morning, they're doing the opposite. And then they're doing whatever institutions do in the last hour. And what I thought was so important and why I'm tying these two together is these are two completely different things that we went over, the last hour and Smart Money Index, and both have been around for decades. And what's so fascinating about it is they both are still using these timeframes of that last hour in the S&P. And I think that's significant that other people that have been trading for decades are using the same kind of data points. And it makes sense. But from an investment standpoint, what's it really telling us? And I think there's some things here, sure. I do want to just point out this is a 5-year chart. This is by Sentiment Trader, and they do a really good job. I have no affiliation with them, but they do a really good job with this data and combining the data. But if I'm to look at this and say, well, what are we really getting from this over, that 5-year period? Well, the first thing is that I would take from it is plus and minus. If you're plussing the end and you're minusing the beginning, like if they're both up and you're minusing that, then you're going to have a cumulative number. That cumulative number is going to tell you when retail is no longer what? Buying and institutions are, or that number is not going to go up. And it's correlated to an actual index. So they're actually taking the S&P index and they're correlating those numbers. And I think that that's very important to remember. So it's not like they're creating something new. No, this is what the S&P is doing. And the S&P is doing this as plus or minus the inverse of retail up here and whatever's happening in the last hour of the market. So what's the first thing that you should take from this in your daily trading? Whatever retail's doing in the first half hour before the 10 o'clock button, you might want to think about doing the opposite. That's usually the first rule of thought. The second thing is whatever's happening in the last hour of the market's probably the way that the real trend is going in the market. But what you're seeing is if you're basing here, and let's clean this all off for a sec. But if you're basing, let's say that you're forming a base here. Let's say that this was a chart and understand that again, that what you're looking at here is super simple. You're just looking at the S&P cash based upon that equation. And if it was calculated this way, this is what you would get. So as it gets tighter and tighter and you can't break those lows and you found a support level like you did for the last hour, you have found a cumulative area where the market is holding. And if you find that cumulative area where the market's holding, then you know that for every dollar that what? Retail is doing the inverse of what they're supposed to be doing. Institutions are combating that, and you're getting that balance. And then it's just a question of the tug of war and who's going to win that balance. Now, in this case, you can obviously see what's happening here, and you break your DTL. And from that DTL, you break out. The question is, would you have broken out so strong if retail wasn't doing what it was doing in here? And institutions weren't doing what they were doing, which is what? Stepping up their buying in the last hour. So this all really goes back to we have retail that wants to get out and we have institutions that want to get in stronger. And that's what turns this. And that's what's so important about it. That's why it's called a smart money index, because think about it. Retail's telling you, oh, we got to get out of the market. We have to get out of the market right now. And then you look at this on a smaller time frame and it's correlated. In other words, we're hitting highs. This is hitting highs again. You're setting up to hit highs, but you're at highs over highs right now, right? But you're pushing. So you're following actually what the market is doing which tells you that you have institutional sponsorship in the last hour of the day. I also thought that this was pretty fascinating. If you take the low here and then you take that retest of that low, which was right here, trying to draw it as perfect as I possibly can. When you got the retest, you had retail that must have been puking and you had institutions that couldn't get in fast enough. And then when you pushed up, what happens? Well, when you pushed up, you might have had retail that couldn't get in fast enough or institutions that were what? Selling. Either way, on that move up, it told you what was happening. And then you have that bottom cumulative area, and then you just start setting up again. But take a look at this on a 1 year. So now if we look at the 1 year, and we just kind of get into that number that's right here. And again, cumulative, and I say it that you should be a little bit higher, but we'll just go to this one for time's sake. And then we can obviously see what I'm talking about here, where there's your bottom. And this is hitting a bottom right here. And what's this doing? So what's that telling you? Who's panicking? Well, retail's probably the one that's panicking because this is going up higher. Retail is panicking more than institutions are selling, is what this is telling us, right? Or else it wouldn't go higher. So the only way this can go higher is if retail is panicking enough and institutions are buying, or institutions are buying so much to counterbalance what retail is buying. Either way, it's telling you that institutions are getting more heavily involved to the upside to counterbalance anything that retail is doing. That's why I think that this is so significant. And that's why I think it's so important to pay attention to. It's actually the exact opposite of what you saw happen here, where you're hitting highs, and at the same time you're hitting highs, you're hitting a lower high, which is saying, yeah, I understand you're taking out the high, but on this side, retail's more invested than institutions are. And then, of course, we got liberated. So when we see this, is it a be-all, end-all? Is it something you have to act on right away? No. I do think that if it was not following what we're seeing in the market right now, it would be a red flag. I do think if you were looking at this right now and you were down here and you're hitting highs and you had some kind of divergence like this, meaning like this was kind of edged and you had a divergence, I would say that, yeah, maybe we have an issue here, maybe we have something we have to worry about. But if you're correlated to it, then it flows pretty nicely. And this is giving us a different perspective than just looking at just the order flow. It's allowing us to look at order flow and also time. And Smart Money Index allows us to look at a couple things, right? It allows us to look at the order flow, it allows us to look at the time of day, and it allows us to actually look at the amount of significance of that order flow, time of day, in the actual S&P cash value, and see what that would look like in chart form if it was just those periods of time traded with those kinds of parameters. So as always, comment on this. I find this fascinating, and it's definitely worth paying attention to as an indicator. Now, I do think this is worth a second, and I do get asked about this a lot, where I'll show data like that, and then somebody will say, well, what is this telling us? You know, I was working with somebody this week, and it really struck me as people need to think about it from this way. You have two hats. I'm just going to draw a line. So when you're looking at the Smart Money Index and you're looking at the last hour, or you're looking at the econ data, and I'm just going to put them in this category. This is your portfolio manager hat. This is the, hey, what's going on longer term? How's this going to affect me? Where's order flow going? What sectors are moving? That would be another like portfolio manager kind of thing, right? This is you taking the longer term outlook and putting that hat on and saying, how is this going to affect the market? What if GDP is negative 4% versus positive 4%? Remember we had that whole battle going on? They're portfolio manager questions where you're developing that long-term thesis. And then you have over here, okay, what is going on right now with non-farm payrolls when it comes out? Okay, that is a trader question, not is this number good? Is this number bad? What about the fact that it's government jobs, blah, blah, blah. Like that doesn't matter the day that the data is out and the market's doing what it's doing. You may have had a wrong read on the market. You might have had a right read on the market, but the market's doing what the market's doing. You as a trader are supposed to make money off of that. Or when the technicals are breaking out, or even if the technicals are breaking down on something, right? It's your responsibility to understand whether they're breaking out or breaking down. If it's going against your thesis of the market, it doesn't matter. All that matters is what? The technicals and price. So when you're over here, knowing when the bond auction's coming out, understanding if you're seeing a massive sell-off in the market because of a mean tweet, is there tariff news that's affecting the market right now that has nothing to do with what's going on with smart money, dumb money, smart index, you know, what the bond relation is, equity risk premium, all of that over here. You can take this, and if it, let's say you get a mean tweet and then say, okay, well, the mean tweets mean they're probably going to sell whatever country on it, so I'm going to short that even though I know that long term it's going to be okay. Or even if your thesis is, oh, it was a good tweet and the market went up, but I think the market's really bad, you still make money. Your job as a trader is to trade. So when you're looking at this, and this is what I see a lot in the comments, this is why I love when you guys comment, because it tells me how to create content. You have to put the trading hat on when you're trading. When you're thinking about things in the world, that's when you're looking at the portfolio management stuff. That's when you're looking at the numbers. That's when we're looking at non-farm and saying, oh, well, it's government jobs and it's the food industry. What does this have to do with immigration? What does that have to do with the 5-minute chart on NVIDIA? Like nothing, like literally nothing. What does this have to do with any of that? Nothing. So it's that differentiation. And I just want to take a moment to break this out for you. Understand which hat you should have on at what time. And that can save you a heck of a lot of money and also create a heck of a lot of opportunity. Speaking of opportunities, it's no great guess to anybody that I'm long more than NVIDIA. It's completely breaking out. People don't really understand they can make their career off of trading like one or two names. You could be trading the same name for 5 years. People don't seem to really get that sometimes. But this is pretty nice setup right here, and you are setting up to go higher. You look at this on the week, and anyone that wants to show me this chart over a period of time over the past 100 years where it doesn't go higher versus it does go higher, yeah, they tend to go higher. You've been basing for a year. A lot of people will look at this and say, that's not a year base. That's fine. It doesn't have to be a year base for you. It's a year base. I've added for swing trades 3 different times to this thing now since April 24th, and I'm in all 3. So to me, it looks like you're going to keep pushing here. I don't really see a reason for that to fade. AVGO. And there's a difference here too, and we should probably kind of explain that difference. So there's a huge difference in buying AVGO. Like our first entry was down here, and we've added like 2 more times, but there's a big difference in understanding your thesis in buying this and trading it based upon the thesis on AI and what's going on with AI and just looking at the CapEx and making a fundamental decision on that. And that's, again, something else that you should be thinking about all the time. This was a great week to really get that stuff down and start looking at it from that, macro perspective and fundamental perspective when we start talking about the stool. And the reason for that is not only do you have the stool, but then you have to put which hat on you're supposed to be looking at with the stool to an extent. But we'll get into that another time. I don't want to digress too much, but I do want to go through this because this is really important. People that are trading, if you're looking at AVGO and you're looking at NVIDIA and you're looking at Oracle and you're putting these in the same category, by the way, Oracle is obviously going to be a beast considering OpenAI is going to do even more with them. This was just the simplest trade in the world. And I want to comment on this too, because I'm going to bring this home. But you need to differentiate your trades. And I'm going to start doing more educational stuff. All this stuff that we're doing is informational, in my opinion. I want to start doing more educational stuff so that people can kind of start walking through this. But this is a great example of what I mean. So this obviously is something that everybody and their sister should eventually look at shorting, right? Like no one really believes that this thing should really be going from 11 to 135, but no one's going to stand in front of the train. So what you have is you have speculative excess, and we all know that. And when you see these kinds of trades, you can either do them or not do them. You could say it's silly, I'm not touching that, or you could trade it. That's your style, and that's up to you. If you start diving into these, they're usually pretty simple and they're just straight out breakouts because people have some kind of short on, and that short is predicated upon a really small amount of shares, especially if you know how to track floats, which I would strongly recommend that you learn how to do. But this started breaking out and we could see it happening. And it gave us like a really great entry. But this is a completely different kind of trade. Like you don't know when the party's going to end with this. You just don't have a clue. Like you can come down here. We should actually do this on a 1. Like you can come down here and watch them fight. Like watch them fight it out right around this level. And that's telling you something. That's giving you that level of interest right here, isn't it? Where, oh, we're breaking out. We broke over and then we came down and then we can't actually break that level, and then we pop up, and then you really start to move. And really, why are you moving there? Well, there's a couple things. You could say that control bar, but candidly, it was the top of that one. And then you formed a 3-bar pattern, 1, 2, 3. And on these kinds of pushes, I tend to get out of the way because I'm waiting for the halts. And I don't want to be halted in these because you don't know what you're going to get. I'd rather be halted short because eventually you know it's going to end. But even that'll like wake people up at night. But this is my point on that. On the short side, you could be here and go, oh, I'm a genius. I'm at 128, I'm glad I held. And then the next minute you're here at 107 and it happens fast and you don't know the day that this is over. So this is more of a speculative trade and you have to put those on. For me, I take it when I can get it. And then what I tend to do is I want to put these shorts on and leave them on. There's a bunch of criteria for that, but I can get into that later. But for now, this thing's just been a money magnet. And they filed overnight or over the weekend for a Form 8, so they're going to start dumping shares on the market. Shocker. But this did present a lot of opportunities during the day for us to trade, and it just gave trade after trade after trade. And you can see all you're doing are the breakouts over and over again. And it's textbook stuff. I mean, I love when people say, oh, the RSI doesn't really work. And you're like, okay, well, here you are, you hit, and then here's RSI again. And then you can just kind of see the negative divergence. You can just send them that if they ever say it doesn't work, and just, you don't even have to say anything. But here's a great trade. And I want to show you what you should be looking at. And it's really going to tie into something. Like, why are you holding that level? Like, why is that the level, right? And we're going to get to that. But here, watch how I pick up that level and watch how we make money off of it. See how many times you held that level? You need to close below that to think that you're going to break. You had a little battle going on right here. I think you're going to break through it, actually. You keep holding that level, so you might actually break through that level. Your volume's insane. There you go. That was a fast $2. I bought it. See how you ate that area up? I think you're going to go again. I think you're going to take up this high. I think you're going to go to 100. Do it. Boop. Trimmed into it. Boop. Trimmed into it. I don't have a choice. I got to trim into this. This should be the bar. Trimmed. Boop. Trimmed into it. And then they're going to halt it. We want to play the halt game. Just give me the 100 and I'll take it. Here comes the halt. Out. I'm out. The halt's coming. Thank you very much. Last bit sold 96.30. That was fun. Now, people will look at this and say, well, you don't know, this thing's going to be worth $1 billion because they're going to buy something and they're going to do this and they're going to invent the widget. And I would just say, okay, NFTs. We heard that they were going to be like the greatest things. Or I remember Tilray. Like, the one thing about this, guys, is I've been through this on so many cycles from doing this for close to 2 decades that I remember, like, oh, pot stocks, everybody had to be in. And now it's at 50 cents. And this was the cat's pajamas, right? Kids still say that, right? It's cool. So understand what you're trading and understand it's speculative excess, and understand it's going to end in tears with somebody saying, oh, I used to have a lot of money. I'm just waiting for it to come back. There's still people that are sitting around waiting for Tilray to come back. Heck, there's still people sitting around thinking GME is going to come back someday. Or what was the other one? NIO. Remember that one? This is going to come back. It's going to revolutionize the industry. So it's just important to understand the difference between speculative excess and what you own and what you don't own. Something else to kind of tie this all together as you get ready for the week. There is a huge difference here in thought process between institutions and retail. Do you think institutions are sitting there looking at this and waiting for this to break a flag before they buy it? No, they're buying it based upon how much allocation they want to have to it. And it's your job to start learning that and understand how you're going to get that read. That's why you've done nothing but go up since this happened. So when you understand that, you can benefit from it. And here's a really good example of what I mean by that. If you take a look at D-Dog was the one that everybody came out and said, hey, no one had that on their bingo card for being added to the S&P, yet here it is. Watch what happens after night. And it's just fascinating, easy, super easy trade. Comes out, sits here. I actually bought it in there and then just got out into this because I didn't want to hold it overnight. But the next day, here's your level again. And you knew that you were going to have buyers. We had a bunch of people that did this one in the room on Friday. And the reason is because they knew. They weren't just looking at pattern recognition, and this pattern was pretty clear. One thing you should always do with these names, I don't like using anchored VWAP all the time, but it does have time and place. Places of pain is the best place to use it because it just shows you where people are feeling pain, whether that pain is not being in or being in, right, to the upside or downside. But after hours, they work great. I can draw, 14 different VWAPs on here and one would hit, and then I'm going to be a guy who goes, oh, see, look, it hit. Like, who cares? Like, which one's the one I have to care about? This one. The most active pain point is the one you need to care about if you're a trader. Period. End of story. Now, if you look at stuff like this, why did this keep going up? Because institutions bought it. Why? Because they had no exposure to it. No one had this on that bingo card, and that's why it did so well. So something like this, as you're coming into it, that's why you're lifting. That's why you could probably still, keep pushing on Monday because they really didn't have exposure to it. And you can see that by the amount of volume that came in on Friday. There is a lot in this video. There are parts of this you may want to watch again. That is it.